Good afternoon, everyone. Welcome to this rundown for global stocks and commodities for the 4th of June. A little bit later today, been out enjoying a game of golf in a wonderful Perth long weekend. Overseas stocks had a terrific week. US and Europe finished very, very strongly. There's, I guess, some hope that Australia may follow through on Monday, but I wouldn't count on it. The way we've been underperforming the rest of the world. But look, overseas is doing very nicely. And one of the things I want to talk about today, I often refer to a focus on investment overseas because there's just so many more opportunities in America. It seems to me that it's a much truer trending market than we have in Australia. So for all those reasons, I've been overseas myself for quite a number of years. But there's another dimension to it as well, and that's the currency. So I just want to focus a little bit today on the situation with the Australian dollar, and for a particular reason. So the case for investing into overseas assets, I believe, is really strong. Now, trading and investing is not about certainties. It's about the probabilities. It's about going where the likelihood of success is the greatest. And I firmly believe that the Australian dollar is ultimately heading below 70, and that's been my position now for probably 3 years. Um, and of late, I'm changing my view to be even more bearish for the reasons that I'll present in a minute. And I think there's a possibility that the Australian dollar could even get below 50 cents over a period of probably a couple of years. I'm not saying it's going to happen tomorrow, but there is a very, very strong case to be made for the Australian dollar being substantially lower. And there's not much of a case to be made for the Australian dollar actually going higher. So it's hopefully you might agree with my case. So first of all, this is the strong case for a big decline in the Aussie. Uh, I think there's a really good likelihood that the RBA might have to cut rates again because of subpar economic growth. And for reason, these are some of the specific reasons that are leading to that subpar economic growth. Firstly, we've still got falling investment in mining and in general business, and I think a lot of people expected that to have turned around by now, but as of yet, it's still not occurring, and I think there's many reasons for that, but a lot of them really point to the government and the lack of confidence that people have that the government, either side of politics, can get their act together. Secondly, we've got some real woes in the retail sector. We're seeing plenty of clothing stores and footwear stores going into administration in Australia. We're seeing the profits really being eroded at Woolworths and Coles. And there's a lot of parts of retail in Australia that are suffering. And of late, we've seen some significant reductions in share price in Harvey Norman, in Myer, JB Hi-Fi, etc. So there's some real woes in the retail sector, and the country is undergoing quite a bit of additional competition. And with Amazon about to enter in the Australian market, it's really hard to see how it's going to get any better. Next, the housing market in Sydney and Melbourne, which has been on an absolutely rip-roaring tear, would appear to be peaking. And whilst no one is really talking about a crash, and I don't think that's going to happen, we could see a significant pullback in Sydney and Melbourne of the order of 10, 12%. And of course, if that happens, then that inevitably has some impact on retail spending. Really importantly, we're just becoming so globally uncompetitive, and I'm afraid the Australian population is just sleepwalking into it. The good old complacency is in full vogue at the moment, and we're just uncompetitive in so many aspects. One of which is our lack of spending on infrastructure, and it just means that we just can't we can't move things around, we can't export things with the same degree of competitiveness that those overseas can do. We're on a very bad economic path, and I don't think a lot of people really understand that because they just look at where we're at now, debt 40% of GDP, and they point to where America is at and other countries in Europe are at and say, well, we're okay. But look at the path we're on. In 2006, debt to GDP was 10% in Australia. Now it's 40%. That's a substantial rise in a decade. And the trajectory that we're on, and this is the important thing, is very similar to a lot of the basket cases, throughout Europe and the developing world. It's the same, and I think it's about time that the media started talking about this in the way that it should be. Next, the cost of doing business in Australia is quite unattractive to overseas investors, and overseas investors are essential to our growth. If we had to fund the investment that's required in Australia, just forget it. It's not even going to be close to enough. And we're just making it more and more unattractive for overseas money to want to invest here. We've got paralysis in government. I don't think anyone can argue with that. And we've now got a general move to the left with the coalition now moving to, very much to the centre or even left of centre. And that really ensures that we're going to have a budget mess for the foreseeable future. No one seems to have any political will to attack the budget mess. And the inevitable consequence of that is going to be a ratings downgrade. And if we get a ratings downgrade, then our currency is going to go with it. So, there's just so many boxes that you can tick. Iron ore and coal prices keep falling, and it's hard to see a fundamental basis for that to suddenly turn around and have those prices jump back up again. Not unless we had a sudden massive surge in world growth and growth in China. And finally, if the Fed raises rates, which they're almost certain to do in June, then the currency premium disappears, particularly if the RBA has to cut rates here because of subpar economic growth. Now, the only reason that the dollar is still in the mid-70s is because of the premium difference between interest rates here in Australia and interest rates in America. If that premium disappears or gets eroded further, then our currency is going to adjust and it's going to be downwards. So there are all the reasons for a decline, and I think it's a very strong case. Now, there is a case against, of course, but I'm really struggling to identify too many factors. One of it could be that Donald Trump really stuffs it up, or the opposition to him is so great that he ends up getting booted out, impeached or something, and that disrupts the US economy to the extent that the Fed can't raise rates. Now, I don't believe that is likely, but it's possible. But other than that, I can't find too many reasons why the Australian dollar is likely to rise from here. So from my perspective, there's an overwhelming case for the Aussie dollar to head significantly lower, and there's not much of a case for it to head higher. So if you want to invest or trade, then playing the odds is obviously what you have to do because there are no guarantees. But I believe the Aussie dollar could fall to 70 or possibly even 50 over the next few years. And that represents a fall of between 6 and 33%. Now, if you're investing in US denominated assets, then not only are those assets going to rise because those markets are doing a lot better than ours, but you're going to get that sort of increase in value caused by the falling Australian dollar before you even start considering the capital gains. So for me, if you don't have a significant part of your wealth in overseas markets, then you are just missing out on a huge, huge tailwind. And of course, there'd be no point in going overseas if there wasn't the opportunity to make better capital gains than we've got in Australia. And I think that's a very, very powerful case as well because, we've got such strong demographic and social change drivers in certain sectors overseas that make growth in profits a very, very high likelihood. And I'm talking US technology and China in particular. And then if Trump can succeed in getting some of his tax reform policies through and some of his pro-business agenda through, then you're going to continue to see strong growth in profits and therefore share prices in US industrials, medical devices, financials. There's a whole array of different parts of the market. And of course, Europe is looking a heck of a lot better at this stage as well. So I just wanted to paint that preamble to this week's look at what's going on specifically with stock markets, because I think there's a very high likelihood that you can get a very free currency kick by being overseas. Now, American stocks, the index rose 23 points, new all-time high, and very powerful finish on Thursday and Friday. And not even a low non-farm payrolls number on Friday night could dent the advance. We've got a strange mix at the moment. The tech majors are getting seriously overbought. They're getting really frothy. I'm uncomfortable about where Facebook and Amazon and Google and Apple are from a short-term technical perspective. Not where they're going longer term. I believe they'll continue to rise, but in the short term, they've risen a lot in a short space of time. So I'm getting a bit anxious about that. But at the same time, we're seeing the general breadth of the market is still very sound. The Russell 2000 sharply higher on Friday night, big gap up. So there was quite a bit of catch up in small caps on Friday night. So the current dilemma with the American markets going as strongly as they are, and also Europe has had a good run over the last few months, is when and where do we add to exposure? That's really the difficult question. I think 2,500 points in the S&P is not out of the question before we get a pullback. But look, all I can offer you is that over the years, I've always done far better when I wait for dips. And as soon as I get tempted into chasing prices, then it usually doesn't end all that well. And I'm starting to see again, particularly from some quite reputable, sensible voices, I'm starting to see a case being made for why this time it's different. And, it never turns out to be different. So that kind of makes me a bit nervous as well. So let's take a look at some charts. Enough for that. You can see the S&P. We had a big dip on the Trump impeachment thing on the 17th of May, and that took us down to 23.55. And then since then, it's gone up by about 85 points. It's been a huge couple of weeks, and May will continue to advance a little bit further yet. Let's just look at the US dollar. US dollar is in downtrend, as you can see, and we could quite easily target 93.5 to 94.5 before we get some sort of meaningful bounce. Turning now to the Russell 2000. This is the actual ETF. So you can see quite a significant bounce. We'd be just going sideways, as you can see, since around December last year. So lagging, whilst the breadth is still good, the Russell was definitely lagging the big caps tech stocks, but some serious catch up on Friday night. Turning now to the NASDAQ. And you can see the NASDAQ just continues to power higher. It was only at the end of the year, it was trading at 4,900, and now we're at almost 5,900. So the NASDAQ has put on 1,000 points so far in the first 5 months of this year. So pretty strong stuff. Aussie stocks, our dollar was steady at 74.4, and it was just a repeat of last week. Volatile, jumped around between 73 and 74, but it's now fluctuating within the lower trading band. The ASX 200 rose 36 points on the week, and most of the top 20 companies are and will continue to be subject to headwinds for years to come, in my view. Now, that doesn't mean that the share prices have to fall. but it also doesn't mean that the share prices are going to go up either. I just think they've got a lot of fundamental things against them. I think the share prices of our top 20 stocks are going to struggle. So if you look at whether it's Woolworths or Wesfarmers in the retail grocery space, whether it's the banks, whether it's Woodside or Santos, which analysts keep trying to find a reason to pick a bottom in Santos, but Santos has been a basket case for a long period of time, and I don't think that anything's changed. And the other area that I'd be really careful is the high-yielding infrastructure stocks. I've been unable to satisfy myself as to how they get away with their business model, where year after year they pay out in dividends more than they earn in reporting earnings. All I can conclude is that they have some way of massaging their reporting earnings so that they appear to be lower than they are, because it doesn't make any sense to me that you can continue paying dividends which are significantly greater than your profits, unless you're monkeying around with a profit figure. Anyway, one day someone might be able to explain that one to me. Let's just take a quick look at the Australian market, and we'll look at precious metals while I'm there. So the ASX 200, we did kick up on Friday. I guess that was in anticipation of what was happening. We had a good Thursday night in America, and then obviously a good session on Friday night in America, which I suspect probably was going to be good anyway, whether the payrolls number was a good one or a weak one. Turning now to precious metals, this was silver, and of course these were up on Friday night with the breakdown in the US dollar. So silver did quite well. We're back into the $17.50 area. Let's look at gold on a weekly chart. First of all, I just want to take a bit of a bigger picture look here. So this is the peak in 2011 at just over 1900. Now, the first thing I want to point out is that we've had from the lows, which were in 2015, we had a perfect 38.2% retracement of this entire decline from 2011. So from the top to the bottom, and we've done a perfect 38.2 to the dollar. That was at 1377, and that occurred in July of last year. From then, we've corrected back. We corrected back fairly deeply, which was a bit uncomfortable. But since then, and that bottom was in the 16th of December, which again was when another rate hike occurred, we've been trending up, higher highs and higher lows. Now, the other dynamic that I would like to point out is that we've got a very, very clear trend line here from that 2011 peak, and it's pretty perfect at the moment. Picks up the highs through here, all through here, and we've rallied back to it, and we're rallying back to it again. Now, ultimately, I think that trend line is going to break, but we haven't broken it yet. And there is a case for gold being lower in the short term, which I'll get to now. And just while I'm here, let's look at GDX. Oh, sorry, one other thing I wanted to do. Let's look at this on a daily chart. So shorter term, we do have a rising trend here, higher highs and higher lows. And you can see from when the last rate hike occurred in December, we had a rate hike and gold sold off into the rate hike. In March, we had another, or late February to March, we had another rate hike. Gold sold off into the rate hike. We're now bumping up against a long-term trend resistance line. We've got the US dollar having been sold off and possibly go into a rebound. What are the odds? It seems a bit too obvious to me, so therefore it may not work out. But what are the odds of a pullback from that long-term resistance line, pull back to this area here, around 1240, 1245, and I think that would be a pretty useful place if you're wanting to look at buying some gold. Let's look at GDX. Now, GDX, gold stocks haven't gone with the gold price in the last few days, as you can see. So we might even get a little bit of a pullback. If you're looking at gold stock indices, if GDX pull back into the 21 to 2150 area, I think that'd be a pretty reasonable buying point. So precious metals, gold up another 11 to 1279. We're trending higher medium term, obviously trending higher short term, and the US dollar is still trending lower. So we still might have a few more days yet where that happens. I think the US Fed Reserve meeting is the 14th, 15th of June. So we've still got a little bit of time before that happens. The market has been selling off into a rate hike. It doesn't mean it has to happen this time, but it could. And so therefore I'd be targeting 1240-ish kind of area. Now in the futures market, there was some short covering, so buying back of short positions, but there wasn't a lot added to the long side on gold. So there seems to be some profit taking on the shorts, but not a lot of conviction to go long. So when you add that to the technical picture and the rate hike picture, it's all starting to to build a case for gold being down in the short term. Plus, we're also seeing a bit of weaker demand in China and India, weaker physical demand. The premium for gold over the spot price has cooled off. So it all adds to a bit of a short-term bearish outlook. Precious metal stocks not leading the advance, so there's another tick. So there's 4 or 5 ticks there, and so buying the dip in precious metal stocks looks a pretty reasonable bet to me. Commodities, copper did nothing, which was surprising considering the US dollar was a bit lower. Would have thought that would have put a bit of upward pressure on copper. And of course, crude oil dipped sharply against the currency move. So the currency should have helped it go higher, but it's dipped quite sharply. And that was what I said last week. I expected to see a decline down from the low 50s, and that decline followed through. I think oil will find a base somewhere in the 42 to 46 range, and that will probably be your opportunity to start to buy into oil stocks. There's the 6-month copper chart, and just switching now to crude oil. So West Texas Intermediate. There's the 3-month chart. So if we declined to 46, we would form a double bottom. So that could be a target. Or if we look at this on a bigger picture, so this is 2 years, then you can see we've also got some other lows down here in around the 42 to 43. So I think one of these lows, either this one or one of these 3, will probably be a good support point for oil. And I probably wouldn't be buying oil stocks until you see that sort of technical pattern play out. So the current positioning, I wouldn't be buying into this market at the moment because the higher and faster it runs, the closer and closer we get to a short-term top. I still remain very bullish. It remains a buy the dip environment from my perspective, but I would be really restricting to the sectors where earnings growth is occurring. I'd be just leaving everything else alone. And I think we're getting to a point now where if we do get a sell-off in gold and oil and copper, then resources could be accumulated on significant dips. But be careful. I would certainly preset a maximum exposure limit for each part of the resources sector. My overwhelming preference is still to the non-resource sectors, US technology, Chinese stocks, etc. There's my contact details for any non-members that would like to communicate with me, and we'll see what next week brings. Cheers.